Obviously, the 50 basis point rate cut was made. That takes rates to a new range of 4.75 to 5%. And it really does mark the end of this hiking cycle that we've seen since March of 2022 that resulted in interest rates rising 525 basis points. That's a lot, and that's had a significant impact on credit markets. And if we look after the meeting, and we compare the Fed's dot plot, which it uses, to signal where future policy might be, compared to where futures markets are trading and pricing in cuts, what you see is a trend that has persisted for much of the last few years, with the market anticipating more cuts than the Fed plans on making based on that dot plot for the rest of this year and for the rest of next year. So in total, the market is seeking about 50 basis points more cuts than the Fed plans to make by the end of next year. We have to consider two things. One is that largely this move was priced in. And what I mean by that is that back in July at the Jackson Hole Symposium, Fed Chair Powell was pretty specific in his word choice about saying that it was the time to adjust policy. And really the market preemptively moved. Like rates fell across the curve already, such that when the decision yesterday was announced, even though there was debate around 25 or 50 basis points, the market didn't move that much. Rates actually ended up, a little higher on the day instead of lower. So the move had already happened and it had been kind of priced into markets already. So at Oaktree, as we think about positioning our portfolios, it was something that we had put in place for some time. The other thing that I think is important to consider is how the Fed is thinking about this cut in particular. And we think about three different scenarios. First is more of the soft landing scenario. And that is really playing out, I think, right now in the market. Inflation has come down. The labor market is still strong, but it's showing signs of weakening. And therefore, the Fed knows that rates are at restrictive policy, and they want to bring them down to their target of 3 to 3.5% because they want to avoid a recession. They want that soft landing. Since that amount of rate reduction was largely priced in, like we talked about, we have no expectation that credit spreads are really going to move from where they are today. In a no landing scenario where interest rates are in restrictive policy, inflation has fallen, the Fed feels that they can trim, but they don't necessarily want to trim to that target because they're afraid if they do, it could overheat the economy and inflation could come back. That could create some volatility, but it also, in that type of an environment where the economy is better than expected, could create an opportunity where credit spreads actually tighten. So an even better outcome for credit. I think in both the soft landing and no landing, you are seeing really strong returns for credit. Now, in the final scenario, which is less likely from a probability standpoint based on where we are right now, that's the hard landing scenario. And that narrative is that the economy is much more weak than the data is showing. The labor market is a lagging indicator, and there is a fear that we may already be in or near a recession. And so the Fed needs to cut rates, and they may cut rates more aggressively than their target. And in that type of an environment where things are slowing and they're cutting aggressively, you could see potential spread widening. And that would be, less desirable for credit. But because yields are still quite high from a historical average perspective, you're still actually not losing much money in that type of a downside scenario. So we do think that the hard landing scenario, you're better off in credit than you are in equities, which require growth to work. I think while the Fed was increasing rates, yes, it would have been great had you gotten, on board and moved to higher yielding products and benefited from that. But it's not over yet. There's still a really attractive opportunity to lock in double-digit yields in credit that are equity-like. If, you take, away the last few years of sizable equity market strength and think about a more normal return for equity markets, which over the last 100 years has been around 10% per year. That's around the yield that multi-asset credit is giving you today. If we are in a economy that is slowing, you need growth for equities to work. You don't need that for credit. We just need to be paid back on our investments. So a soft landing or a no landing, low growth scenario work very well for credit. They don't work as well for equities. So I think if you're thinking about asset allocation on a relative basis, especially, you haven't missed the boat. And yields, while they have come in, they're still above average compared to their levels back in 2021 and certainly post GFC. So I do get the question a lot about spread. And with spreads being so tight, should I wait until spreads widen to come in to fixed income? And what I say is as follows. The health of the economy is okay. Spreads reflect that. They reflect a high yield market that's the highest quality it's been in the last 10 years. We had COVID, which had elevated defaults, and we got some of that out of the system. And so I do think that the lower spread levels make sense for where we are today. And with that high yield, you don't need spread compression to get an attractive total return, whereas historically you did when yields were much lower. So I encourage people to still come in to fixed income for the income. You forget it's in the name, fixed income, but I really think that today the case is strong for that.